Okay, I'm going to take a look at a bull put credit spread, and you could see whether or not this is a trade you'd like to make in your account. Very popular. It's a bullish strategy. In this example, I'll look at Apple, and let's see, I plugged in a couple of trades down here. Let's say if we were going out to March, which is 28 days out, and a lot of people will trade these within 30 days, 45 days. So what you have here is a bull put credit spread with Apple trading at about $130, and here we are, we're selling this 125 and buying this 122.5 put for a credit of 62 cents, which is, we're just using one contract. So one contract equals 100 shares of stock. So that is going to give you a credit of 62 cents per share. So that comes out to $62, which is about a third, the width of the spread, and the width of this spread is $2.50. So we'd be looking to make a profit here of $62, and our total risk would be $188. Okay, so this is obviously a bullish trade on, if you had a small account, this is fine. This is a fine trade to make if you're bullish. But I think there's a couple problems with this. Number one, you're trading so close in time that you get this purple line is it's today. It's your T+0 line, and this, it slopes down pretty quick, and that's called gamma, but I won't get into that. But you're trading so close in time that you really don't have a lot of options, so to speak, to adjust this trade. You can obviously adjust the trade. If this trade goes lower, you have to look at this as two separate trades. You're short the 125 and you're long the 122.5. So if this stock goes down and not by a lot, this is about $5, and as we've shown, Apple Apple moves around a lot, and $5 is really not a big move for Apple. So you're going to be short here at 125, long at the 122.5. If Apple comes down here, you're going to be on this end of the trade, so you'll have a losing trade. And to recover from this, yes, you can roll down, roll out another month. You can do all that. You can have theta working against you if you're down in this area here, which is right here. This theta is your daily time decay. It is a pretty good trade to make, for smaller accounts. But what you'll see a lot of the times is people, they don't want to trade just one contract. People trade, 10 contracts because they don't want to just make $62. They want to turn that into, maybe $620, and within 28 days that would be a nice trade. And a lot of times that'll work out that way, but in the long run it's really not a long-term strategy, and it's only pretty much, I would say, for certain occasions, or it's going to be used in combination with other trades that you have, and it could be something that could fit in if you wanted to get bullish. But that is the issue with that. People end up trading too big, and all of a sudden you're short 10 contracts at 100 $25, and you do the math on that, the notional value is 12,500 times 10. So you could really hurt yourself. And a lot of people advocate putting these trades out over the month and then closing them within 2 weeks. And you definitely want to close it before expiration, or else this curve here is going to really steepen, and you're going to be stressed out because you don't know where the stock is going to end up at expiration. And even after the close, there's potential for the stock to move down, and guess what? You could get a sign. So I wouldn't trade these so close in time, and just remember that you are short here at 125 and long at 122.5. So there, you could basically look at it as two different positions. And I always say just trade one contract. Just keep it at one contract. There's nothing wrong with making trades like that, and as long as you're bullish on the stock and you're looking just to make a little bit. But even if you go, okay, you close this out at 50%, okay, so you make $31, and okay, that's a trade that you could live with. It's still a profit, okay, but I just don't like trading so close in time. And there's people that will trade like this month after month after month. When you hear, well, I don't want to disparage anybody, but there's a lot of that marketing on YouTube here. You'll see these channels that are, saying, hey, you can make 10% a month, or you can make all this money every month. And the reality is, if you hear someone tell you how much money you're going to make, you're not going to make that money. I can pretty much guarantee that, because this is not a consistent way to make money, in my opinion, because you just have to look at the chart. I mean, look, 96 to 135, down here to 100, up here to 124, down here to 108, and so on. So moves, $5 moves are very common in a stock like Apple. Um, so, I mean, another option would be, okay, you go out a little bit further. You go out 60 days, or whatever this is. April would be um, almost 2 months. Okay, you go out 2 months, and still, okay, it's a $71 credit here and $179 risk. The slope of this purple line here is not as steep as trading the March month, which would be too close. So this might be a better option, and you can go a little bit further out. This example shows a 122.5 short and the 120 long, and that's giving yourself a little bit more room, but still same story. You're still short at 122.5. So look at it like two separate trades, and so you're short here and you're long here at 120. So it's basically you're hedging yourself. And if this was a short position here, and you're exercised, you're going to end up owning 100 shares of stock. And these are American style options, so that could happen at any time. So I just think it's a trade that you could use in combination, like I said, with other trades. If you need to get a little bit of positive delta, and you're bullish on a particular stock, it's definitely hyped a little bit, kind of like the covered calls, a little bit over marketed, and a lot of people find themselves in trouble pretty quick with trades like this. Maybe a little bit better would be going out to September, for example. Um, here, this example I'm just showing, you're shorting the 105 and buying the 100. So I mean, it's not a quarter, it's not a third, it's a quarter. So if you take in $100, your risk is 400 here. So you take in 25%, and which is great, and you get a lot more space. I would rather make a trade like this and just kind of, just allow this line to move higher, and if it does drop, if you decide to, you can roll. It's a little bit easier to roll when you're further out in time. It gives you more options on your options. So that's how I look at it. And you can see this purple line. It's not as steep as the other two examples I showed. So it's a decent way to get bullish on a stock. Like I said, the problem is traders will pump up the number of contracts because they don't feel like they're taking in enough credit. So that's where you can get in trouble. So I always, as a general rule, and it's not set in stone, and I'm not telling anybody how to trade. You do as you wish with your money. But I say one contract is enough risk, because if you look at the notional value here, if you're assigned here at 105, okay, that's 100 shares times 105. That's over $10,000, right? So that's what you have to consider as well. And that's the only issues I do see with these credit spreads. This is a bull put credit spread. Um, Another thing is, by the way, your long here is going to decay faster than your short, because the long is further away from the money. So that's something else to consider. And if you're thinking like the Tasty Trade crew, which I mean, I like those guys over there. That you can learn a lot from them. You can go to their website; everything's free. But keep in mind that they are operating a business, and they're teaching you to trade options for a reason. They want you to sign up for their platform and trade with them, which is fine. And they say trade trade small, which is great, and trade often. I would say trade small, but try not to trade too often. They want you to trade often, obviously, because it's more commissions. And they want you to trade within a 45-day window and close it at a 50% profit within 21 days, if I recall correctly. 21 days before expiration, close it out. But what happens if you're at a loss at 21 days before expiration? Do you let it go? That's what you have to consider. If you're over here and you still have time, what do you do? You're right on the edge. Do you take the loss, or do you? I mean, it's just trading so close in time and trying to collect a third is not what I would consider a very safe trade. And if you pushed it out further out, if you went out to, I mean, say you went to 115 and let's see, 115 and 112 and a half. Okay, your odds of winning on this trade is great. You'll collect $13 and your risk is 237 in this example. So what's that, 5%? Not even. Um, so you could get your win rate up like this, but all it takes is one bad stock and you're down here, and it's going to wipe away all those little bitty trades that you made. So that's what I think about credit spreads. and this bull put credit spread, and all the more reason I stick with trading these short puts out in time, and I give myself lots of space, and it's perfect. I just trade keep it at one contract, and I realize this is not for everybody, and this is this is for people that have risk capital. I'm definitely not a financial advisor, and nobody knows your situation but you. But I will say there's no easy way to making money. So that's what you have to keep in mind when you hear these. There's a lot of marketing out there for people to sign up to trading. Trade alerts. They're winning. All the time, and you know they have all these disclosures, and there's no guarantee of making money. Okay, but uh, so I just thought I'd go over the bull put credit spread. Hope you have a great night. Bye bye.